Good evening, friends. So today we'll discuss, or we can recap something onto what we tried in yesterday's class. IAS 16, Property, Plant and Equipment. So present standard, that is in the present accounting standard in India, it is covered under AS number 10 in the name of accounting for fixed assets, and AS number 6 depreciation, accounting for depreciation. So these two clubbed together we are going to address in IAS number 16, and name is also changed, Property, Plant and Equipment. Certain basic principles regarding what we have in AS 10 and AS 6 is not getting completely changed, but there are some differences between the present accounting standards and AS number 16. That alone we are just going to learn, not the entire standard we are going to discuss now. It is only a recap session only. So by believing that we know the subject in advance, we are just going to tell the differences between the present standard and IAS number 16. So present standard, in which it is dealt in AS 10 and AS 6 as we referred earlier. In IFRS, it is IAS number 16. So easy for remembrance also, we can add these two to remember this particular number. Then exclusion, real estate developers are excluded in the present standard, but does not exclude. So does not exclude, we understand it is indirectly included. Then component costing or accounting. So as of now, if you just take a simple example, mobile. If you just take a mobile, we have mobile set as well as charger. So mobile life and charger life may not be the same, but just if you want to capitalize mobile, we won't do so, but generally if you just take a simple example, if you want to capitalize mobile, the whole set we call it as mobile at present standard. Assume cost of the mobile is 20,000, we used to depreciate this 20,000. But this 20,000 includes for mobile, for example, 19,000 and charger is 1,000. Life of this mobile, because of regular usage, it may deplete very soon, but charger even we can use it for some other mobile also. If you buy also, interchangeably it can be used. So life of this charger will be different from that of this particular mobile. So in IFRS, what they say, you just break this into two. So for this portion you charge or provide depreciation separately, for this portion you provide depreciation separately. And this is not something told newly in IFRS or IAS 16. It is there in the present AS number 10 read with 6 also, but it is not mandatory in nature, it is only recommendatory in nature. But in IAS 16, it is compelled to follow. Just only an example. Similarly, we can understand for a bigger asset, if you are able to identify the part or component for which life is separately distinguishable with that of the other portion, we can capitalize each portion separately and we can charge depreciation. So that is what we call it as component costing or accounting. At present it is recommendatory, here it is mandatory. Then even if you just take for example AC, when we tell cost, the cost includes all the cost till the asset is ready for use, we use to tell, like purchase price or installation, all those things we are telling. So as how we used to tell that God, the day on which he is deciding our birth date, immediately our end date also it is decided. Like that, in accountancy we used to think about the estimated useful life, and immediately we are capitalizing the installation cost, but at the end of the life we have to do something like dismantling, which is opposite of this installation. AC, if we take, once its useful life is over, we need to dismantle. This for a smaller asset, we are just taking this example. So dismantling does not involve something greater work for regarding AC, but huge plants involve some cost to be incurred. So that cost also we need to take it for capitalization purpose. And main objective of depreciation, which is relating to asset, is that we used to study in school, that is in school days, right from school days, providing funds for replacement. So when we provide funds for replacement, in future if you want to dismantle, even for dismantling you will incur some cost. That cost also we are estimating now itself, but that cost exactly we cannot add it to the today's cost, like installation cost we are adding, we cannot add. because of time value of money, we need to take it into today's terms, which we need to discount it. So the discounted value, we need to take the dismantling cost. Again, objective being providing funds for replacement only, or spending that amount only, recovery of cost. So it is not dealt in AS 10 at present, but referred in AS 29. No discounting is referred in AS number 29. But here provision is to be made, discounting is mandatory. Then replacement. If any portion or component of a asset is replaced, in present accounting standard, we need to see we used to tell some example regarding certain things, like some information if you know regarding the standard costing. There we used to classify fixed overhead variances, like fixed overhead variances will be classified into some reference only. It will be classified into expenditure and volume. Volume variance will be classified into capacity and efficiency. So for students, we will tell this example. If you incur any expenditure that is going to increase your volume or capacity or efficiency, then we need to capitalize it. Else we should not capitalize. So at present Indian standard, if you just take for the purpose of replacement, it is saying it shall be expensed, because a student who is getting, for example, 70 marks, because of his friends and contacts, he is getting 50 marks. Now someone advised him to join for some tuition. So he went for tuition, and after joining tuition, again he is getting 70 marks. So is there any increase in efficiency? Means answer is no. Again he has been brought back to normalcy. But after joining tuition, if he is getting 90 marks, then there is something, value addition is there. That is what our present standard says. So he is again brought back to normalcy, so expense it. But IFRS says existing asset is de-recognized, that new asset should be, or whatever replacement we have done, that should be capitalized. Then spare parts, AS 10 present standard read with AS 2 also. If that spares are specific to an asset, we need to add it to cost of the asset. Suppose if it is general in nature, initially we should treat it as inventory stock. As and when we consume, we charge it off to P&L. But here, if it is used for more than one period in connection with an item of property, plant and equipment, it should be capitalized. We need not worry about whether it is specific or not specific. Then major inspection overhauling expenditure, here it is expenditure. Here we need to capitalize. That is, existing asset will be de-recognized, the new asset will be capitalized. Then frequency of revaluation, here it is silent. Though we have in AS 10 cost model, revaluation model, at what point of time we need to do revaluation and all, does not refer. But here depends upon the changes in fair value of the property, plant and equipment, we need to revalue the asset. And estimate of the life or residual value, all these things in present standard how it is addressed, IAS how it is addressed. Present standard, whenever we used to do revaluation, we need to revalue the residual value also, scrap value also, but here at least every year end. So estimate, even if you just take the depreciation, only cost is fact. All other items like estimated, life is estimated, scrap value is also estimated. So these wherever estimated and all we are having, whether we need to revise it or not, the answer is every year end we need to revise it. So useful life, again scrap value to be revised, useful life to be revised, requirement reviewed at least. Okay, here at least every year end review should be made. Then requirement of review of method of depreciation, here not required, here at least every year end. Then change in method of depreciation, whenever there is a change in method, in general we call it as change in accounting policy, but here it is considered as change in accounting estimate. And effect of this, generally whenever there is a change in accounting policy, especially regarding depreciation as per AS number 6, we need to give retrospective effect. But for change in estimate, we should give only prospective effect. So because of this reason, we should give a retrospective effect, but now we should give only prospective effect. So these are all the major differences between the present standard and IAS number 60. I'll just try to the extent possible. For example, we just take any machine. For example, even AC also we can take. So in AC, a particular part, suppose we need to replace some coil or some portion we need to replace. For example, we have bought that AC for 20,000. At present, there is no system of component costing. So, what we used to do, suppose if we change that part, before that we told some example like 70 marks a student is getting, because of some reason he is getting 50 marks. Again, by joining tuition he is getting 70 marks means, then he has been brought back to normalcy only. There is no value addition we used to tell. But IFRS or IAS says definitely there is a value addition, because originally he was in, before joining tuition he was in 50 marks, but by joining to tuition only he is coming to 70. But Indian accounting standard is seeing these two, they are comparing. In this scenario, 20,000 for which we have bought an AC and some portion is worn out. At present we don't do this component accounting, so that part cost also will be included in this 20,000. For example, that portion amounts to, say for example 2,000. Remaining portion of the asset is 18,000. We don't capitalize 18,000 separately, 2,000 separately. So what we used to do, total 20,000 for which we used to provide depreciation year by year. So indirectly we are providing depreciation for this 2,000, that portion also. Assume that 2,000 became, for example, after providing depreciation 800 rupees. Because of usage, wear and tear, all these reasons, we have the worth today, and we have decided to replace that particular part. Because to bring back to normalcy, again, we are not getting proper temperature or some reason we can just tell, to bring back to normalcy. It is working at 16 degree minimum means after changing that it is not going to work at 12 degree. Again it is going to work at 16 degree only minimum. But at present that chillness or cooling is not there. Again to get that effect we are going to replace that part so that it is going to work properly. As if day number 1 when we bought how it was working, like that it is going to work. But when it is working at 16 degrees Celsius, we cannot make it as 12 degrees Celsius. So this 800 is the WDV of the particular component which is included in that. For example, this portion also 18,000 also became some number. So overall 18,000 became, for example, some 12,000, some number we can just take. So totally it is 12,800 means that 12,800 includes this portion also. And the new component when we buy, assume we have spent some 2,000 rupees for that. 2,200 for that. For the new component we have bought, which is going to replace the old particular part, would mean at present scenario this 2,200 will be expensed. When we buy this, we need to treat it as an expenditure. We'll debit P&L. But IAS 16 says this 800 you take it to P&L because it is old. Present Indian standard says this you take it to P&L. This will continue to be depreciated. This 12,800 includes 800. So this 800 will continue to be depreciated. This 2,200 will be expensed. Because this 2,200 is not going to increase your efficiency. 70 marks is not going to become 90 marks. 50 again brought back to 70 is what we understand. So Indian standard says this 800 will continue to be depreciated as it is. That is, we will use new asset, but books will contain old value. New asset cost will be in P&L. But the component cost will be in P&L. But IFRS says this 2,200 you add it to, suppose if you do component cost accounting, 12,000 to which you add this 2,200. Then for this or this portion, if you are able to trace the life separately, provide depreciation separately, this you continue to depreciate separately. 800 you write it off to P&L. So present.
We recognize that particular coil aspect as being de-recognized.
Correct. That portion alone. Present la physically, bookwise. Physically, presently we are throwing out. Books la it is existing as an asset. But IAS 16 la physically also that is old asset we are telling. Old asset it is thrown out. From books also you throw it out by debiting to P&L. Only that component. It is separable. Correct.
Because we are talking about a component.
Correct. The particular portion, entire asset also can be replaced. Govin prepares financial statements under IFRS in the year 31st March following transactions occurred. On 1st April 14, Govin began the construction of a new production line. Cost relating to the line are as follows. Details: cost of the materials, list price 12.5 million, trade discount, recoverable taxes incurred not included in the purchase cost, employee cost of construction staff for 3 months to 30th June, note 1, other overheads directly related to construction, payments to external advisors relating to construction, expected dismantling and restoration cost. Production line took 2 months to make ready for use and was brought into use on 31st May. Other overheads were incurred in the 2 months ending 31st May. They included an abnormal cost of 3 lakhs caused by major electrical fault. The production line is expected to have a useful life of 8 years. At the end of the time, Govin is legally required to dismantle the plant in a specified manner and restore its location to an acceptable standard. The figure of 2 million included in cost estimates this amount is that expected to be incurred at the end of useful life of the production plant. Appropriate rate to use in any discounting calculation is 5%. Present value in 8 years is approximately 0.68. 4 years after being brought into use, production line will require a major overhaul to ensure that it generates economic benefits for second half of its useful life. Estimated cost of the overhaul at current prices is 3 million. Govin computes its depreciation charge on monthly basis. No impairment of the plant had occurred by 31st March 2015. So, actually question in which they are not asking exactly what is it they want us to do, but we can understand since it is a question on property, plant and equipment. The questions possibly it could be what should be the cost of the asset and what could be the corresponding depreciation in general. In addition to that, since we have the issues regarding dismantling and all, so what is the provision to be created for dismantling also we can understand. Though normally in our questions they will tell find out this, find out that, those things are not there, we can understand. Relating to asset, we can try these 3 questions. So first thing we need to know what is the cost of this asset. Before that, he is preparing financial statements by 31st March 2015. And 1st April, he has started construction of new production line. Cost relating to the line information given. And here the production line took 2 months to make ready for use and was brought into use on 31st May 2014. So we can just tell depreciation can be provided generally in accounting only when asset is ready for use. So April and asset was brought into use only on 31st May would mean 2 months they have taken. So in a year consisting of 12 months ending 31st March 15, first 2 months they have incurred these things, or certain things they are expected to incur in future. Then only asset is put to use or ready for use we can tell. From the time only we can claim depreciation. So last point in which they have clearly told, Govin computes its, or note number 5 in which they have told, Govin computes its depreciation charged on monthly basis. So though we are having the asset that is which has started construction of the new production line from 1st April, it is ready for use only by 31st May, and for the year ending 31st March 15, this is a stage during which asset is getting ready, and for this period we will provide depreciation since he is charging on monthly basis. And during this period the cost incurred and asset is expected to be used for some 8 years and all, they are just telling. Dismantling cost and all we have. One by one we will just discuss. What are the costs to be capitalized? So general rule is that the term cost includes. So at present standards also we can tell in AS number 2, all asset related standards like AS2, AS13 or AS10, 2016, all these places, generally cost includes any cost incurred till asset is ready for use. It includes like purchase price or any installation charges. Sorry? Putting that asset into use, any cost will be incurred, or any taxes of non-refundable nature freight inwards, delivery charges, everything till the asset is ready for use. And it generally excludes, in all these standards, certain things are common in general, but every standard is having some specific issues. It excludes like discount or rebate, any taxes of refundable nature and all, we need to exclude from the cost. And especially, we need not include. If it is included, we need to deduct. Certain principles are even same in IFRS also. But in addition to the normal cost, we need to add the dismantling cost also. Normally we'll add installation, etc. We need to add dismantling cost also. But installation today, dismantling after some time. So this will be taken at present value. Then in this problem, one by one information. Cost of the basic materials, list price, that is the quoted price, invoice price is 12.5. We have some trade discount 20%. Trade discount will not form out of cost. So 12,500, 20% discount, that is in thousands. 10,000, it is already excluding discount only, so no need to worry. This 10,000 we need to take. Then taxes of refundable nature will not form out of cost of the asset, that we can exclude. So recoverable sales taxes not included in purchase cost. Since it is not included, we need not worry. If it is included, we need to deduct. Then employment cost of construction for 3 months to 30th June 2014. The production line took 2 months to make it ready for use and brought into use by 31st May. So in our case, they have paid up to 30th June. But asset is ready by 31st May. So that 3 months out of which 2 months will take it for capitalization relating to construction. So 1200 out of which 2/3 out of 2 will be taken for 800 will be taken for capitalization. Other overheads directly related to construction. Other overheads were incurred in the 2 months ending 31st May. Exactly it is 2 months only, but it includes abnormal cost of 3 lakhs caused by major electrical fault. So abnormal loss, if any, will not be included in the cost. So out of 900 to the extent of 300 we need to exclude. Only 600 will be taken for capitalization. Then payments to external advisors relating to construction. Since it is relating to construction, attributable cost we need to capitalize it.
It is the same in both the years. Both the years as well.
Correct. Any percentage also. Expected this is something new. This is after that life and all whatever they are telling we are going to incur. But the 2000 we cannot add it to all these numbers just like that. We have the discounting factor. So 2000 into 0.68 in today's value we can add it. So 10,000 we can take 800 plus 600 plus 500 plus present value of this 2000 will be taken up for capitalization. So first question, what is the cost to be capitalized? Would mean we can just tell 13,260 should be taken for capitalization. Second issue, for this 13,260 which we have capitalized by 31st May 2014 till 31/3/15 for this 10 months, how to provide depreciation. Suppose if you are not following component accounting, problem is very easy because the life is 8 years. Easily we can take 13,260 divided by 8, you will get per annum, and for per annum you divide by 12, per month you will get into 10 months. We can easily finish off the problem. But since we have component accounting, by reading point number 4 years after being brought into use, the production line will require a major overhaul to ensure that it generates economic benefits for second half of its useful life. The estimated cost of the overhaul at current prices is 3 million. So out of this particular asset which we are having, by breaking into the components what we told, worth rupees 3,000 and remaining portion is 10,260. This 3000 for which they are telling 4 years after being brought into use, production line will require major overhaul to ensure it generates some future economic benefits for the second half of its life. So for this 3000, we need to take the life as only 4 years. After 4 years, it will be replaced. Then for this 10,260, we have 8 years life. So for this 3000, which is having 4 years life, we can provide separately depreciation. Per annum, it comes to 750. That is 3000 by 4 years. For this 10,260, 8 years life, per annum, if you compute, it comes to 1283 on an average or 1282.5. But we need to take for monthly depreciation. So this, if you convert it 750 per month, we'll get some number. That number for 10 months, if we calculate, we'll get 625, 62.5 you will get, into 10 you will get 625. Here per month, if you compute, we may get 1000 and, that is for 10 months we'll get 10,069, 106.9 will be getting. So depreciation both put together 1694. So in our balance sheet, asset will be capitalized for 13,260 and depreciation will be provided for 1694. Remaining will be the carrying amount of the asset. And in profit and loss account, we need to take this depreciation 1694. Now, this depreciation 1694 is on 13,260. This 13,260 includes this portion also at present value. 13,260 includes present value of 2000. For that portion only we are providing depreciation. In the sense, depreciation is useful to accumulate some funds for replacement of asset or for meeting some expenditure, in our case P2. So by providing depreciation, definitely our cash balance or bank balance is going to be protected. To that extent, profits will not be withdrawn. Now, if we know, when we are including in this 10,260 or 13,260, the present value of the 2000, now itself we know in future we have some matching liability. So considering that, as per prudence, we can create some provision for that dismantling also. So provision for dismantling, present value, that is at the beginning, if you just take at the beginning in the sense on 31st May, somewhere here, when we are capitalizing, present value of the 2000 we took it at 1360, that is 2000 into 0.68 we have taken. But this 1360, when we are preparing balance sheet on 31/3/15 or when we are preparing profit and loss account for the year 31/3/15, when we create provision, we cannot take 1360 because 1360 is 10 months back. Now after 10 months we cannot take same 1360. That 1360 in today's value. Usually what we will do, future value will bring it into today's value. But here 1360 at 31st May would mean what is the value on 31st March 2015. That is future value is what we call it as unwinding of discount. So how we can arrive at that unwinding of discount would mean this 1360 into 5% is the rate per annum. Reverse working, we took 1 divided by that 1 plus R we have taken. But future value for which we can add this 1 plus R we can take. But this will give per annum, we need only for 10 months. So that amounts to some working to some 57 or something. 57. So we need to create a provision for 1360 plus 57 will be the total provision to be created. Even that provision will be taken to, sir, full provision or only that interest portion will be taken to pay. 31st of March. P&L to provision for 11,900 2 provision 1360. So interest debit to provision for dismantle over 57. Here only that interest component will be debited to P&L.
Correct.
And here 1360 plus 57 will be shown as provision, closing provision. Major overall expenditure, here we have told we need to de-recognize existing asset and the new asset will be capitalized. So after 4 years, this whatever we are going to replace, that particular portion's present value, it is 3000. So the present part in that main asset will be useful only for 4 years. After that, we need to replace or we need to do some major overhauling.